my trading webinar, and it's been a while since I've done one. I think it's been about 3 months. And part of the reason for that is I've been incredibly busy, but I also wanted to just now share with you everything that's going on in the markets, but also some simple trading strategies for private investors to follow, because through social media, I get asked that a lot. So let's get started. Just let me know you can all see and hear me. There's a chat box. You should be able to see and hear me. And once you let me know that you can do that, we can begin. And I'll wait for you to catch up and put that into the chat box. And I want to welcome everybody who's on here. And it's a slightly unusual time for me to be doing it. So Robert, Dunstan, the kid, Gio, Carl, Eric, Terry, Derek, John, Carwin, Nilesh, Ravi, Jitendra, Alfredo, Chowder, John, Alex, and everyone else. Great. Everyone can see and hear me, and we can start. So let me turn the screen share on first and foremost. He says optimistically. There we go. Lot to cover in a short space of time. So I'm going to start off with simple trading strategies, why I love trading, why I think you should too, and how to avoid the problems that so often happen in trading and so many people experience, okay? And that's what this webinar is about. Simple strategies, simple business plan, what's happening in the market, and at some stage, I'm going to show you this as well, so you can see what we're monitoring at the moment, what trades are going well, which ones aren't going so well, what do we do about the ones which aren't, how much might we make from the ones which are, and what can we expect in terms of returns this year from trading, and most importantly, return on our time, because that's what really matters. There's no point getting a positive return if you're spending all your time doing it, and that's a major problem with trading for people as well. This is not financial advice because I don't know your personal circumstances. I can see your names and everything on here, but I don't know your personal circumstances. Gio, that might be Jeff. Hi, he says from Malaga, because I saw Jeff in Malaga. So fantastic, everyone else. Feel free to stay. Oh, also, let me know where you're from on this as well. Okay, let me know where you're from. Now, we've got people from around the world today. I'm going to do polls whilst we do this. You might see polls pop up on the screen. Do feel free to answer those. And the reason I'm doing polling as well is because it keeps it interactive, and I want you guys to be entertained as well as educated during this. Okay, quick checklist. Look, in all seriousness, we're here to make money. It's the words of David Kite, who, when I wrote this book, which is when I wanted to get into trading, Lessons in Trading Strategy from the World's Leading Traders, which the Financial Times then thankfully published, David Kite said to me, we're here to make money. And I've never heard somebody else sort of say that so, boldly, so brazenly. And it occurred to me that actually there's nothing wrong with saying that. So we're here to make money. So make sure you close your doors. It's all quiet. No TVs on. Focus on this, please. Grab a notepad. You'll also need a cell phone. You'll need a cell phone to take images of some of the slides, because in the replay, some of the slides won't be there just because they're proprietary and they're a bit confidential. Okay. Also, what I'd like to know, center of the world, Cardiff, of course, what I'd like to know is what times you prefer for these webinars. So if you put it in UK time 7 p.m. or UK time 1 p.m. or whatever, or US time, then let me know, and I'll make sure I put the webinars on at those appropriate times as well. Look, this is what everybody's talking about. It's all the cost of living and everything else. That's really accelerated thanks to COVID as well, where people have got used to working from home. It's really accelerated people's desire to have side incomes. And so many have gone into trading, as they have been for the last 20 odd years since I've been writing books on trading. You can see them over my shoulder. And 70 to 80% people lose money. So I don't want people to go into trading if they're going to lose money, obviously. And the point of this webinar is, over the next 1 hour, 90 minutes, is, if nothing else, I either remove your FOMO, whether it's worthwhile you doing trading at all, or at least you don't make losses. Okay, ideally, icing on the cake, you make profits. That's ideal. But let's get rid of your FOMO and making sure you don't make losses. As I said, people are more interested now than I've ever seen in 20 years on having this side hustle, side gig economy, working from wherever, having the freedom and all the rest of it. All right. So that's what this webinar is about. I'm going to give you insights from the people who mentored me, advised me, taught me. There are these people that are in my book, as I said, that were in here. So that's where the source of my data information comes from. It comes from my experiences as a hedge fund manager, but more importantly for you, it comes from the experiences and expertise of a bunch of other people as well. So it's really important you know where things come from. Too often on the internet nowadays, you've got some software company popping up and saying, hey, £3 a point will make you £70,000 tomorrow morning. And it's like, who are you? What makes you qualified to talk about any of this? Okay. And there's just no evidence of anything about them. So these are some of the people who, as I said, were in the book. They taught me when I was a student at university, and all I did is copy best practice. It's like if you go to tennis school, the coach teaches you what to do and you copy that. Okay, you might try and improve upon it. You do more practice, but that's all it is. That's all trading is. It's just copying what other people have done. You're not looking for some secret holy grail. So what is it, and what are the strategies involved in all of that? And that's what I'm about. Okay, and as always, start with demo accounts. We're not going to risk real money, right? I'm probably the only person I think on the internet who ever says that, because everyone else is trying to sell you some kind of brokerage account and wants you to risk real money because they get the kickback from the broker at the back end. When you lose money, they get a share of your losses. I don't like that. So I'm broker independent and I don't want you to be losing money. It's as simple as that, right? You'll have seen lots of stuff like this. I don't know spreadex. I'm not endorsing them. This was something that we found several years ago, as you can see from the date, floating around the internet. And I'm sure it's true as well that, you know, their top clients did this. And these are the numbers which people get excited about. We're not going to aim for these numbers, okay? This is the kind of stuff which lures people into filling in lottery tickets. What's the probability of winning? Next to nothing. What we're going to do, rather sensibly, rather professionally, rather in a disciplined manner, is say, well, we're going to start off with a demo account. When we're consistently profitable on that, we're going to aim for maybe $500 a month, $500 or £500 a month. Some months you might make more, some months you make less or nothing, and it irons out. There's no guaranteed income. It's not a bank account. So what we want to try and do is learn the skills first. It's about the skills, not the amount of money. The reason for that is if once you've got the skills to make 500, you've got the skills to make 1,000. If you've got the skills to make 1,000, you can make 2. If you can make 2, you can make 4. Getting the money, that's a separate issue. Friends, family, earnings, that's a separate issue. That's not what this is about. This is about the skills to actually start with any sum of money and see how much can be made. Okay, and actually can you learn the skills, right? It's that way around. So it's not about, oh, you can make $1 million. Well, you can't make $1 million if you start off with £1. Sorry, you can't. Okay, so we'll go through a business plan so you can work out for yourself, is this actually even worth it? And if all of you left at the end of this webinar and said, thanks for that, Alpesh, I've realized it's not worth it for me, or it takes up too much time, or it takes up too much skill, great. At least you'll never have FOMO about that, and you can go drop shipping on Amazon or find some other side gig. Ideally, what I want, because I love trading, is that 10% of you will say, wow, I think I can do this. Right, I'm excited. And it's always at just 10% of anything in anything. You know, I go play golf, it'll only be 10% of the people who are going who will say, yeah, I really want to do this. That's what it is. That's what it is. Okay. Do follow me on LinkedIn. Don't ask to connect unless you're a client, please. Just follow on LinkedIn because I don't accept connection requests. Just follow and you'll get loads of free information, articles, videos, tons of free training from me and from other hedge fund managers. I just did an interview with the head of Said Business School, Oxford Business School, basically, and his views on success and so on. So you'll get a whole load of stuff there, all right, through that. These are the reasons we're doing it. Now, this is really important with trading. People think, oh, trading is about making money, isn't it? No, it's not. Because if it takes up too much time and it's not fun, then you're basically a slave who's a miserable slave who's not earning much money for the hours they're spending. So it's got to be fun, freedom, fulfillment, funds, and then eventually, hopefully, philanthropy, and you'll do something useful with the excess money. Okay, that's what it's got to be. If it's not going to be those things, don't do it. The people who don't make money trading are the ones who don't enjoy it, okay, for a start, or become slaves to their desk because they found some strategy, which means they've got to sit at their desk all bloody day long. Well, if that's going to be the case, you're going to mess up because you're going to start trading out of boredom or frustration, and you're just going to blow up. All right. And you're going to have a miserable life. And my job is not to get you to have a miserable. If I want you to have a miserable life and still make a profit, I'd say go get a job at McDonald's. Okay. You'll have a miserable life and you'll still make a profit. Trading's not the trading. We've got to make trading in a way where it's enjoyable. And that's got to be my job. My job has got to be, whilst I give you the warnings that 66% are losing money with this account and that one, I've taken those screenshots from various brokers. And roughly, I mean, the numbers have come down a bit. About 60% to 70% now lose money trading. Well, hang on. You've only got 2 decisions to make, whether to buy or to sell. That's a 50-50 decision. If it's a 50-50 decision, how come 66% are losing money and not 50%? So I'm going to show you what they get wrong and how you can move into the 34% who are making money. And 34% is actually not a bad target to go into. But we've got to make enough money. There's no point, oh yeah, 34% made money, £1 in a year after spending 1,000 hours on it. That's no good, right? So that's why we're going to have a business plan, so you understand all of this. And the reasons they lose money, essentially, I can put it into 4 different categories of trader. There's this, the one who thinks, oh, I'll just have a really high target and I'll put a stop loss because I heard that's a good idea, and it is, lower down, and I'll just make it. Well, that won't. That's what will happen. And if you don't believe me, do 100 of these trades. Okay, do 100 randomly on any instrument. That's what will happen, right? Equally, they say, oh no, I've got to narrow it down a bit. I'll have a more reasonable profit target and a more reasonable stop loss. Nope, this is what will happen. And you can experiment this all yourself. You can do it yourself. Okay, you don't even have to use live cash to do it. Then you might say, oh, I know, I'll get rid of my stop loss. These are probably, I don't know, people who, you know, they read the odd thing here, there, they see something on TikTok and they think, oh yeah, I'll get rid of the stop loss. That's obviously the problem, right? And they just build up loads of losses, which they never take because they kid themselves that those don't count. Doesn't work, doesn't work. And then you got the so-called scalper, okay, probably paid 10 grand to some trading college and they thought, oh, I'll have lots of little wins, and they get lots of tiny little wins and they're so excited. It feeds the dopamine because they put their stop loss so far away. This is what will happen. Those are the numbers. I've published this in my books and we've based this on actual research because we just got somebody to do, got an intern to do 100 demo trades, not real because we knew he was going to lose money. We don't enjoy losing money. And these are the results. These are typical. That's what would happen. So how do you avoid all of this? Well, essentially, this is what trading is about. Okay, as you know. See that green arrow? Whenever you see a green arrow in this webinar, I'm going to show you the trades in a second that we're looking at right now. I'll show you these in a second. Okay, and you can see it on screen there. But before I do that, just to give you what are the tools of what we're going to talk about today? Well, you've got this little green arrow down there. What does that green arrow mean? That's a buy signal. Whenever that happens, how do we get that? I'll explain that and I'll share that strategy with you. And that's all you're looking to do. Buy low, sell high. You could be a supermarket. You could be an energy company. Buy low, sell high. It's what all profit in life is. When you sell your time, you're selling it at a higher price than you're paying for it yourself. Well, you think you are. And if you're a private investor, and by the way, all this data, you know, it can be euro, sterling, could be anything. That price data is the same price data you and I get as George Soros or a hedge fund manager gets. The difference is the amount of capital. So we need to learn the skills. If the only difference between us is not the data, it must be this, and obviously capital's the big difference between us and them. It must also be the skills. So we want to get those skills down. Okay, that's what this webinar is about. It's getting those skills down. I can do a separate one on how do you raise capital for a fund, but that's a completely different story. Okay, and you can see the difference should only be the amount of capital you have, the amount of capital you have. But you know what happens? How come professionals make money, even though they all get the same data, and private investors, 66% lose money? As I showed you, 66% lose money. And we're going to show you the few things the private investor does wrong which makes them lose money. The reason, well, about 4 or 5 years ago, I wrote a book, which has subsequently been published, where we researched what private investors were doing to compare it to what professional traders were doing and to see, were there certain things that private investors were getting right who were profitable, which the professionals were also doing? Did they actually stumble upon it by accident? And also, were there certain instruments, certain directions, certain times of the day, which gave an edge? So we took a load of data to work that out, and I'll share that with you as we walk through this webinar. And we found that there was, as you'd expect. And we're very data-driven. We're very sort of take a scientific approach to things, which is where's the source? Where's the evidence? Where's the evidence for things? And this is what a typical month would look like. Well, actually, there is no typical month because a typical month equally could have been a losing month. Okay, so there isn't a typical month. But here's what a month, ideally, a good month would look like. An ideal month would look like. If we only got these, I'd be very happy. It's the FTSE. It's a 1 hour bar. And what you can see there, and what we're after is, we didn't get in at the bottom because we don't have a time machine. We don't have sort of witchcraft powers to get in at the market bottom, and we should never try. Anybody who claims that they can is lying. Okay, we get in after the momentum and the trade has already started. The trend has started. We got out. That was a losing trade here. This short, you can sort of see me moving the mouse. Hopefully you can all see me moving the mouse. By the way, I'll end this poll. Will the FTSE be higher by the end of 2022? It's pretty yes and no's are pretty evenly balanced, as you can see there. A third, almost are the numbers. Well, let's see what people think about the Dow. Put a new poll up there. So look, we had a losing trade. We had a small winning trade. But wait a minute, Alpesh, why aren't all your trades just big winning trades? Don't you have some secret trend software which gives you only winning trades? Some secret strategy you're going to tell us? Well, I'm going to tell you a strategy. It's not a secret because I was taught it by somebody else, by the people that I mentioned earlier on. But more importantly, how come we're not all just making big winning trades? Because that's not true. That'd be unrealistic. It just doesn't happen. This is what typically happens. You have some losses, but if you have a good strategy, which I'll show you one of our 10 in the fund, and you can copy it because it's the simplest. It's the one I was taught by Bill Lipschutz. What happens is that should be kept small. The losses should be kept small. And we get some big wins. Great. Small losses. Get some small losses. That's ideal. If every month looked like this, I'd be over the moon. Every month doesn't look like this. That was a good month. That's not why I showed it. I picked a month and it happened. And like I said, look, you can flip this around. So if you might say, what does a bad month look like? It looks like the opposite of this. But we get more good than bad months. Simple as that. Okay? There's not this, oh, you're always right. I thought you'd always be right. No, all we're trying to do is this. We're trying to turn 50-50, which is a coin. It's a coin toss. It's random. Into just a slight edge in our favor, so we get a net return. That's all we're trying to do. It's all we're trying to do as traders. And we're trying to avoid stupid mistakes private investors make. Stupid mistakes like this, where private investors say, oh, you know what? I got a little profit. I'll just take that. That's fine. And they show you those and they close the positions and they leave all their losing trades open. Put your hands up if you've done that. Oh, just ignore the losing ones. Oh, how profitably? Oh, 9 out of 10 of my trades were profitable. What about if you include all your losing ones which are still open? Oh, let's not talk about those. Well, you can kid yourself and delude yourself. Human nature does that all the time. The other problem is this. We're not going to be doing this. We are not, for trading, going to be looking at tons and tons of macroeconomic data. How do I know? Because none of those guys did. The world's leading traders don't. On CNBC, they may well talk about their world economic views. But as you're about to see, when you're trading, let me pull something up. I'm going to pull up euro dollar. Okay, where is it gone? Euro US dollar. Okay, there we go. Euro US dollar. Do you think we looked at the economic data on the 25th of August at 3:30 a.m.? No, and we're short this, by the way, at the moment. So we're short euro dollar. How do I know? Because we got the signal there. Do you think at 1:30 today? Okay, this is Central European time, so it's 2 hours ahead. Do you think we looked at suddenly European data? No. So we're not looking at macroeconomic data because we're looking to trade smaller trends. We're just trading based on trends. It's a lot easier. You could do it. I'm not saying you can't do it the other way. You can do it the other way. It's just not the way we're going to do it because there's a lot of ways to skin a cat and we don't want the hard ways to skin a bloody cat. Okay? That's the way the dinosaurs might have done it back in the day when they didn't have price data widely available. Private investors might have tried to take a punt on that. I don't like working hard. So this is the other problem. We're not going to be doing this either. We're not going to trade, remember, off this. People say, oh, sorry. I opened it in the wrong window. People said, can't see. Sorry, I opened it in the wrong window. It's this window. I should have opened it in. There you go. So that, well, we're short euro US dollar, that bit, we didn't look at the data, macroeconomic data there, or indeed here. And it changed so quickly anyway, the direction of the trend. We looked at the trend. We kept it simple. That's what we did. Okay. So let me move that out of the way now. Apologies, I opened it in the wrong window. So we're not going to be doing this either with lots and lots of lines. We need to keep it simple. We need to know when's the momentum starting. This is where we buy, and a few simple strategic rules. So we're going to go through the simple strategic rules. Now, believe it or not, there's ample research done on trading. Of course there is. Universities do it. The hedge funds do it. Academia does it. Of course they do, because there's trillions involved. So you better believe people do it. Okay? Of course they do it. Of course they look at all of this stuff. And the reason they look at it is, like I said, there's a lot of money involved. So how do we improve our gut feelings? Well, we do it through practice. Just like at school when you did maths class. You just kept on practicing the problems until you got on top of it. This is what your performance will look like, whether you're going to be a billionaire or just mildly profitable and making 500 a month. Okay, it's going to be looking like this, because every successful professional trader in the world, their results end up looking like this. Okay, what is it? Out of 100 trades, you'll get about 15 to 20 which are big wins. Why can't they all be big wins, Alpesh? Well, if we could see into the future, the reason is, let's say you enter something, you think it's going to be a big win because that's the only reason you'd ever enter into a trade. And then back in the day, I used to say Donald Trump does a tweet and the market changes direction. You can't foresee that. You can't see into the future. That's what's going on. You'll have a bunch of small wins and small losses. We try and minimize those, but that's what will happen. About 40% of those will be split between those two, or 45% will be those two. Okay? The key to success in trading and the strategy, which I'm going to discuss one strategy. I'm going to keep it simple. Okay? One thing I've learned over the years is you don't bombard people with too much information. You just keep it simple. If something works, you stick to your knitting. That's all you do. Not 100 different things and searching for some holy grail. We've got to make sure through our strategy we never have big losses. Well, that's the secret right there. Just avoid the big losses. Guess what you're left with? If you avoid the big losses and you've only got a bunch of small wins which are cancelled out by small losses, you can only be left with big wins. That's profit. The problem most people make is they're sold on the lie. Oh, we'll show you how to get lots of wins. Oh yeah, 70, 80, 90% wins, 100% wins. Nonsense. The other thing that we learned from the world's leading traders was this. And it's one of the biggest lines. Oh, you make a few big bets. You just wait until you're absolutely certain, then you go all in, like at the casino when you're playing poker. I thought that was it until I met the world's leading traders. And each one of them said, no, you don't ever do that. You'll be sacked. You'll lose all your money in 2 minutes. I'm not promoting the book. I'll show you. I'll give you a link at the end where you can get the book for free. I don't need the royalties. You don't make a few big bets. What we're going to also talk in this webinar is, okay, how little money we're going to put in. And we're not going to be watching the screens all the time. What we're actually going to do instead is this. We're going to pick about 20 instruments. You're going to scan them for 15 minutes in the morning, place one quality trade, and I'll show you on the business plan why that's all you need, or 15 minutes in the evening, or 1 hour, 1 day a week. Okay, so you take your pick, 15 minutes a day, or 1 hour, and place 5 trades. If it's 1 hour, you scan for, or 1 trade a day. All right, that's it. And I'm going to give you the timings. We're going to focus on 15-minute bars, 30, and 1 hour. All right, although I've shown you here, I've put Apple up just because, and this wasn't one of my trades, it was one of my students. They had a great run up on Apple and they've been over the moon. They're currently short on Apple and you can see it there, and it might well resume back upwards and they might get out of it soon. I don't know. But that's not one of mine. It's one of my students, but they sent it to me and I thought, well, I don't normally do 4 hours, but I really liked how well they got this. And was that luck? Possibly. So that indication came there. Why? Why was there momentum there and not another point? Why and how did that happen? So we're going to, don't worry, you won't need to write all this down. I will run through it and show you the numbers. So let's remove some of the problems of making losses first. Then we'll look at the strategy. Then we'll look at the business plan of how much can be made. And then that's it. We'll do Q&A. Okay. We're going to do it that way. For the US, again, people are a little bit unsure on this. I'm going to start another poll. I've done it again, haven't I? I've put it on the wrong sodding thing with Apple. Sorry, people. I keep doing this. Let me show you Apple. I apologize. I keep putting it on the wrong screen. I might just swap screens around or something. So there's Apple, and it's the 4 hour. There you go. And that was the entry there. I apologize. I've can't keep putting it on the wrong thing there. And that's the short signal. Why? What happened? We'll go through that. We'll go through what happened. So we're going to look at this 15 minutes a day. You're going to scan these. Okay, pick 1 trade a day, and I'll show you how. And these are the instruments we're looking at the moment. We're in some of these positions, in others we're not in them, but we're just waiting for the next move. So with the Dow, just so you know, we're short the Dow at the moment on that. What does that yellow line mean? That's the stop loss. Why is it there? I'll explain that in a second. What's the dotted line? That's where we'd add to our position. How, why, what, when. I'll explain that as well in a second. So that's the Dow. We're short the Dow at the moment, just so you know. What was the other one I particularly wanted to show you? The FTSE. The FTSE, we're short and we've exited it. It actually, because it went down here and then went back up again, it hit our stop, so we're out of that now. So we don't, but we're still keeping an eye on it for the next trade. So I'll tell you whatever the next trade is if it comes up during the webinar on that. But we're short the Dow, so let's see what happens as the markets kick in the next few moments. So let's see what happens with that, right? And I'm going to go through all of that with you and break it down in numbers, 20 instruments, 15-minute, 30-minute, 1 hour. How do you scan them? How do you find the momentum? You place one trade and you go 15 minutes. Why do I only want you spending 15 minutes? Because it's about return on time. If I ask you to spend the whole day and you make £100, well, that's not worth your time. If I ask you to spend 15 minutes and you make £100, that's worth your time. Okay, that's why. The main problem we're going to try and avoid. So look, we're going to remove the problems first. Then, like I said, strategy, and then we're going to go into business plan and then Q&A. Right? Going to keep it very clear, distinct, and I'll go through anything that I've gone over too quickly as well. Now, traders. A proper professional trader trades a small position relative to capital. This is what you're going to have to explain to your spouse when they say you're a gambler. Gamblers trade big money relative to capital. A trader does a lot of small trades. A gambler does a few big trades. We're not going to gamble. We're not going to make any of these mistakes. We're not trying to guess the news. We're not going to add to losing positions. Don't ever do that. I've already saved you a ton of money by teaching you that. And how do I know that? Don't take my word for it. Don't fight with me over it. Don't say, oh, no, I always add to my losers. I always make lots and lots of money. Average down. Ugh, right? Well, you can argue with me and the world's leading traders, or you can follow the bad advice you see on the internet. Gamblers start big and they take small profits because they're worried because they started too big. They have no stop loss, or it's so far away it's meaningless. And after a string of even 3 losses, their account will be down 10 to 50%. That's how you tell a gambler. That's what people on the internet want you to do because they've got a kickback from a brokerage. They'll say, please use our brokerage. They've got a kickback from their brokerage. And that brokerage wants you to lose the money because the brokerage acts as a casino. It's the house. It's not matching buyers and sellers like an estate agent. It's the house. Whereas with the trader, we're going to teach you all these professional aspects. And these professional aspects you can see here that I'm showing you are the ones which will make you the money. Okay, and we know that because that's what the professionals do. By the way, watch to the end. I'll make sure you got a free gift. And the free gift is a whole ton of books and a whole bunch of more materials that I've created for you as well. Okay, so this is the essence of what we're going to do. Let's now get to the strategy part. We've highlighted enough some of the problems of why people lose money. Now let's make sure we drill down into the strategy. So get your pens and papers ready. Okay, so here's a typical price chart. All right, and how do we get that? Well, this software you see here is called MT4 and it's free. It's broker independent and it's free. It's broker independent because all brokers offer it and it's free. All the data is live, real time and free. I'll say that again. It's live, real time and free. And it's broker independent. So I don't even need to mention a broker to you. Many brokers offer it. All right, there. So I don't even have to say, oh, please go to my broker because they give me a nice little kickback. No, I don't like that. A, B, C, D. A is the up arrow. That's where we got in after a bit of a trend start. How do we do that? How do we know to get in there? I'll explain that in a second. Okay. What's point B? That's the stop loss, right? You know, we know successful traders have a stop loss, but they know how to place it. They have what's called a volatility-based stop loss. In other words, the more volatile the market, so these bars, whether it's 15-minute bars, 1 hour bars, 30 minutes, doesn't matter, whatever time frame you're trading on, the more these move up and down, that's more volatility. So you might say, well, I'll do it by experience or by looking at those or by the average true range, doesn't matter. And you might say, well, I'll put it about 2.75 times the average true range. You can Google that. But it doesn't matter. It's what the principle is. It's a volatility-based stop loss. The more volatile the market, the further away the stop loss. But not so far away it's meaningless, but not so close that it's going to get hit by market noise and just normal up, downward movements. Now, with time, that you get experience. What we do is we just program it to tell us. Not because it's the best point, but because it's the principle that matters. And we don't want to keep on having to guesstimate or even think where to put it. So we put it there. A volatility-based stop loss. And here's the other secret of all hedge funds, volatility-based position sizing. Further away the stop loss, smaller the position size. So whatever the distance from A to B is, the position size changes accordingly. So you're never risking losing more money just because the stop loss is further away because the market's more volatile. That's genius because it means in more volatile or risky markets, you're not risking losing more money. because your stop loss was placed based on the volatility. That is probably the most important thing I could teach you today. That is what puts you more towards the 35% of people who make money in the markets than any other thing I'm going to tell you. Of course, I got to tell you how to get that green arrow and the up buy and the momentum, and also how to make sure that those losses are relatively small. If you get it wrong, like that at point D, that was a losing trade. So how was the stop? How did we get out of that quick enough and turn that around? Those are the critical factors. So here's the simplicity and the beauty of it all. The distance from A to B, okay, you tell your broker, right, I want a stop loss. If you're a beginner, you'll say a fixed stop loss. And then the distance from A to B is the distance from A to C. It's the same distance. And you say, if you're a beginner, you'll make that a fixed take profit or limit order. So you just, you find your momentum trade, which we'll come to in a second. And you just say, right, stop loss is here at point B, and therefore take profit must be at point C. That's it, job done. If you're intermediate level, then you won't have a point C. You'll just have a trailing step stop loss. So as this moves up, this stop loss will just carry upwards and take you out whenever. And when you're advanced, you'll have the trailing stop loss, but you'll add to your winning position at point C, and point A will become its trailing stop. I'm not going to go into the advanced stuff at the moment, but that's where the big money's made, by adding to your winners. Winners add to winners, write that down. Winners add to winners, write that down. Losers add to losers, write that down. VSL, volatility-based stop loss, write that down. Volatility-based position sizing, VPS, write that down. Most important things I can teach you. I didn't invent this. It didn't come to me through a flash of lightning. I did not walk up a hill and God did not speak to me. This came from professional traders who I met. Thankfully, I did. The cleverest thing I ever did in my life was say, well, if I want to be a trader, I better meet the world's leading traders. How can I do that? I didn't think, oh, if I want to be a trader, I better read a couple of books and then risk my whole life on it. I thought I better meet the world's leading traders. And that's what I did. Okay, so this is how we're going to break it down. Selma, S-E-L-M-M-A. Stop loss, I've already explained that, volatility based. Money, position sizing is volatility based. We'll go in the business plan how much money you put in a second. Mind, well, we're going to use this process, so that avoids us having all sorts of psychological issues. One way we're going to remove the psychology is you're going to only spend 15 minutes scanning the market. So you're not going to trade out of boredom and frustration and all those other things. So that's how we avoid it. And by having a process, we avoid it. Entry, we're going to come to in a second. Limit order, if you're a beginner, I've shown you where that is. And adding to winners, I've shown you where that is already. So we've gone through a lot of that already. The main one is entry. So let's talk about entry. Let's talk about how does the entry work. Now, this is what I tell my students. Okay, take a picture of this if you wish. Might not show up on the replay, actually. Might remove this. Start. 20 to 24 instruments. How do you decide which instruments? Well, I put them on, actually, the ones we're looking at, on Telegram and for free each morning. And these are the ones we're looking at the moment. So take a picture of those. Those are the ones. How do we choose what to look at? Well, the way we choose what to look at, and by the way, just gone. Let me zoom into that one. Oops, I put it on the wrong flipping thing. I've done the wrong thing again. One sec. Put it on the wrong channel. One sec. Move it across with my fat fingers. That's Microsoft. We've just got a long signal on it. We'll see how it transpires. So there was a short on Microsoft, okay? And that came on the 18th. And if you're looking at the 1 hour time frame and you've got a day job, the 1 hour time frame is perfect because the trend will last about 7 days, 18th to the 24th. Okay, that's how long it'll last. And that's how long the Microsoft one lasted. 7 days. It lasted trade speculators with an edge gambler with a scamble. Okay, so that's where we are with that one. The reason for doing it this way is now you know and don't have to guess and worry what should we look at. And the psychology part we're removing more and more of. So 20 to 24 instruments. See our Telegram channel daily on what we're looking at for the next trend and the next signal. The signal, the trend, we want it to be smooth. We want the prices to move smoothly. We want them to be clear trends. Let me put it this way. No matter how complicated or simple a system I give you, an algorithm I give you, a rule I give you, if you take that up Mount Everest, it's going to be a lot harder than if you're driving a car than it is down a smooth country lane. So we want instruments with smooth trends, okay? Is the entry within the range? In other words, is the price still near the entry point where we got signaled the entry when we looked at it? Because you might not look at it when the signal came up. You're not supposed to look at the screen all day. It might be, oh, there was an entry signal 3 hours ago and the price is still near that level. Great, I can buy it. That way you don't need to be at the screen all day. Fantastic. Especially when you're looking at 20 to 24 instruments, you find a signal and you say, oh, actually, the price is still near there. So I think I'll just go into it. Now, even though I'm a bit late to the party, doesn't matter. Citibank. Let's have a look at Citi because we've just had a buy signal on that, right? So that's Citi. And you can monitor this in your own time live. So we had a short there on the 18th. And then now we've got a buy on Citi on the 1 hour time frame. Okay. And that's what Citi's showing at the moment. And the issue with Citi will be, okay, fine. Is that going to keep going up? And you can see it should be, if you Google it, it should be at about 51.17, or you can see the prices on there. And that's Citi. We just had a buy signal, right? There you go. So it happens even when we're in the middle of a webinar. The point of it is there'll be ample where the prices are near it and you only want one traded in. I'll show you in the business plan why. Okay, entry within the re-app, set, step, trailing stop, easy enough. We get our computer to program it in the computer. I'll just show you. It already tells us because we know where the stop loss is going to be. It's going to look. It's going to be volatility based, and it says it there. SL 50 spot 32. Okay, it's told us that's where it is. Not because it's got some magic formula, but because it's using a volatility based stop loss. Now we could have done it without the computer, but why not use a computer to do the hard work, just like you use a calculator? Beginner, you know what to do. Set, take profit, or leave. Step, trailing stop. All right, trade size so that if you hit the stop loss, you don't lose more than 1% of your capital. Simple, right? That's it. That's it. That's your flow chart. That's how simple it is. Okay, but wait a minute, Alpesh, there's one thing you've not told us. You've not told us how do we know when to enter. You told us what instruments to look at. You told us MT4 is free, but you've not told us how do we know when to enter. So let me show you how I know when to enter. I think I did this earlier, didn't I? Oh, maybe I didn't. Right in the last 10 minutes, and you'd have to stay for the 10 minutes. Can I tell you something we spun out of the hedge fund? It's a piece of financial technology, or Fintech, finance meeting technology, that I spun out of the fund. Can I tell you about that right in the last 10 minutes? The reason I ask for your permission on this is sometimes I talk about it at the end and people get really upset that I talked about something personal. That's important to me. So this stuff works. Pay attention. Here it is. You might be wondering, hang on, surely these strategies are so secret. Nobody knows them. No, they're not. When we're raising capital from pension funds, from family offices, high net worths, we have to disclose what our strategy is. People don't just give you money and say, oh, yeah, you're a good man. I'll pay for you. You look handsome, chubby bloke. Yeah, I'll just give you some money. It doesn't work like that. You've got to show them what you're doing. Okay. And we're not the only ones. Man AHL, which is one of the largest funds, they disclose it. These are trend following hedge fund managers. John W. Henry owns Liverpool Football Club. Okay, my favorite on there is David Harding because he owns Winton Capital, which is based out of Hammersmith. And they're all doing the same strategy, buy low, sell high based on trends. So that's now what I'm going to show you, the trend models. This is from Citigroup. Can simple trend strategies work long term? Yes, was their answer. Yes, has been our experience as well. Okay, so just so you know, this isn't like, oh, yeah, some bloke. Oh, do you know what I used to do? I used to play around on my computer and I suddenly stumbled across the Holy Grail. That doesn't happen. No, we're just copying what those guys, those hedge fund managers did. This is from Winton. This is one of theirs. Actually, I don't think it's 350 billion. I think it might be closer to 35 billion. My apologies. I don't think it's 350 billion, but you can probably Google it. How much are the assets and management on Winton Capital? This is one of their slides, and it depicts exactly what we do. And this is what I'm going to show you now, the entry part. That's the strategy part. Then we're going to do the business plan. Then we'll do Q&A. Got it? That's the rest of the webinar. Entry, strategy plan, Q&A. Got it? So trend starts, the bottom. We can't pick the bottom. We don't know it's even the bottom. One thing for sure, we're not going to go in when it's still falling. There's a bit of a lag. Their words. And people go, lag? You're supposed to see into the future, Alpesh. I thought you could. This is the biggest mistake. When I'm on the BBC, people say to me, oh, so you're on the BBC. Oh, you must know what's going to happen in the future. Come on. Ask yourself, how stupid a thing is that to say? You know it's a daft thing to say. Okay? And they think, look, they think we're looking at the future. That's my YouTube channel. All right? That's me on the beeb talking about oil, and me saying, yeah, we got this trade right. And Sally says, yep, I remember. And what's going to happen? This was with oil. Okay, we're not actually forecasting the future. All I did was look at my trends and say, yeah, we see this continuing higher as things stand. That was it. That was it. And people think, oh, he can see into the future. He must be really clever. I mean, don't get me wrong. Every time somebody goes, God, you must be incredibly clever, I'll take that. But that's not what this is about. That's not what this is about, my friends. This is not about IQ and all the rest of it. You don't need any of it. But even a monkey can do this. You buy there, you sell here. That's what we're doing. Okay, so how do you find that out? Well, we don't fight the computers which are out there. We use them to look for those trends. How do we use them to look for those trends? These trends that I showed you earlier, these trends, notice those trends. They don't always work out. Look, we thought that was going to fall further, and suddenly something happened which nobody could foresee. Okay, so we know sometimes we're going to be wrong. It's a bit like tossing a coin. You might get a streak of 7 heads. Doesn't mean that that coin is biased or you're better at tossing a coin. You got a streak, a winning streak. Don't read too much into it. So this was a chart with a winning streak. We might get a losing streak. What matters is overall, are we profitable? Or as my mentor, Bill Lipschutz, put it, he's the guy on the left. Warren Buffett, you recognize, was his chairman at Salomons. People didn't realize Warren Buffett was a chairman at Salomons. What he said and what's in that book, that's where I'm getting this from. All right. I don't want, again, I'm not trying to be fake humble, but I didn't invent any of this. Okay. You can call me clever if you wish, and you might. But that's got nothing to do with this part. Okay. That's got nothing to do with this. I just copied what worked. I wish I did invent it, but I'm not Isaac Newton. And what Bill said is, if you're waiting to be right 80% of the time, you'll never make it as a trader. He also said, don't gamble before the news. He also said, we're not in the forecasting business. So when I'm on the BBC talking about which way oil's going, I'm telling you about which direction the trend is. And you know why? Well, you'll have seen headlines like this in the FT. Forecasters flummoxed by competing drivers for oil price. We don't know as much as people think we know. We're following a trend. It is the most stupidest profession in the world. Buy low, sell high, following a price trend. And all those billionaires did it. You know why they're billionaires? Well, other than that, they managed to raise capital off it. It's because they were willing to do the simple thing over and over and over again. Whereas most people want to look for complexity. So here are the important numbers. 15 minutes, scan 12 to 20 products, one screen, one trade per day, 20 trades per month. Okay. How does that business plan look? And then we'll look at the strategy again. So where's the, oh, come on. Sorry, my fat fingers and my fat mouse. Here we go. There we go. So that's City. Oh, the buy's going up. Might not. It might turn into a loss in a second. That's nice and convenient for a webinar that we got to buy on City and it started to go up a little bit for now. Might mean absolutely nothing in 2 minutes. Okay. But the point of it is we know where the stop is. We know where to add to the winner, and life's, pretty breezy and easy for us on that basis. So let's look at the business plan and then the final part, the entry. How did that entry come about? Because it's all very well me drawing it on a chart, but this actually shows what it looks like in real life. See the market bottom? We didn't get that. We didn't get it while the market was still falling. It went up a bit. Well, what told us that? What were we looking at which told us that, which gave us that? Well, we basically were looking at stuff which is already out. What, Alpesh? I'm giving you heavy clues now. What was it that you look at? And I'll show you that. And why do you use computers to make your life a bit easier? Well, doesn't everybody use computers to make their life easier? And if the computer can save me a shed load of time, or rather my team a shed load of time, then fantastic. So let's look at the final part, the business plan. Oh, that's my mum, by the way. Always makes an honorable visit. I do not know why Prince Charles is bowing. That's my mum. Okay, so let's go through it. Trading's like driving. I'm going to do the business plan first, then the entry strategy, which is the final part, and then Q&A. Trading's like driving. Initially, it looks too bloody difficult. Go back to when you learned to drive. Wing mirror, steering wheel, brake, clutch, accelerator, rear view mirror. And I've already said to you, so you might think, oh, give up. But look at the freedom and joy you get from driving. Same with trading. Oh, what? Stop loss, entry, limit order, money management, volatility-based stop loss, adding to winners. Forget it. I don't want to do it. Yet, you overcame it with Learning to drive, you can overcome it with trading, because the freedom you get from driving is the joy and freedom you should get from trading. So it's worth doing a bit of persistence. That's my simple point. Okay. So what are the road to returns? So this is what Bill did to me. I was at university and I said to Bill, remember Bill Lipschutz, global head of foreign exchange trading at Salomons back in the day, now hedge fund manager of the year and Hathersage asset management hedge fund manager, and said to Bill, okay, Bill, he knew I was there to interview him. It was because I wanted to know, how do I get rich? I mean, I was a student. If you're a student and you're speaking to the global head of foreign exchange trading at Salomons, he's not stupid. He knows what's in your mind is, how do I get rich, Bill? That was what was on my mind. I grew up with that silver spoon in Leeds. I'm sitting in front of him. We met in London, actually, at the Berkeley Hotel. Then we met at Mark Slater's home, who was head of UK Forex trading at Salomons. And we met in New York. He used to live at 77 Beaker Street. Anyway, for the interview. So he was with us, probably about the second person I interviewed. Of course, I want to know, how do you get rich? I mean, come on. And how many people get that opportunity in their lives as a student at the start of their careers to say, shit, how'd you get rich? So he said to me, right, let's do a business plan first. He didn't say, oh, do this secret thing. Here's some secret superpower, obviously. He said, well, let's explore that. So this is what we did. Piece of paper and sat down. Maximum loss, 1% of total capital. He said, assume your total capital is £20,000. Now, you don't have that today. That's not the point. You will eventually get that if this is an activity worth doing. You'll find one way or another of getting it. But let's just assume your total capital is £20,000. In any event, you're going to start with a demo account, never risk actual real capital. Okay. And whether it's CFDs, spread bets, futures, you can do this with all of that in any event. Okay. So we start off with that. Now, this is important because for anything in life, you need a business plan. If you don't have a business plan, you don't know where you're going, you're going to mess it up. So maximum loss per trade would therefore be 1% of £20,000. So if the stop loss got hit, your trade side is such, you'd only lose £200. Simple. Yeah, 1% of 20,000. Not a problem. So that's your trade size. Easy to work out. Most brokers, when you say this is where my stop loss is, you can work out, oh, if I bet this size, I'll lose £200. Okay, that's the right size. Or most people get this wrong and they lose too much. So they have 3 losing trades and they've lost 80% of their capital. You've just avoided that problem because I've just taught you that. Now, assume for a moment you're a tiny bit better than a coin because of the strategy part I'm going to show you on momentum next in a second. Okay, we've got 10 strategies in our hedge fund. The first and oldest one is the one Bill taught me, and I'm going to show you that. And we've improved upon it by using computers to make it easier. We used to have to do everything manually because the computing software didn't exist. It does now, so we can do it. Let's assume you're a bit better than a coin. Not as good as God, who's right 100% of the time, son of God 90% of the time, grandson of God 80% of the time. Let's just say you get it right 60-40 for argument's sake. Okay, and this is too optimistic, so we're going to dial this down in a second anyway. So your average loss, as I said, will be £200. Your average win, because remember, winners add to winners. We're going to make sure we've got a strategy where we're adding to winners. Should be more than your average loss, mathematically, statistically, logically, because you're adding to winners. So that's 300. Let's say you do 100 trades, Bill said to me. And I said, okay, so I'm writing all this down. I'm going through the math. I'm going, hang on. That means 60 times 300. I'm making profits of £18,000. I still remember where I was when I wrote this. I went, oh my God, call my parents, tell them I want to leave university. I was at university at the time. Tell them I don't want to be a barrister. I'm dropping out of uni, £18,000, more money than I'd ever seen. So all I want to do. And he said, well, hang on, you've still got your 40 losing trades to account for. I said, yeah, but that's still a net profit of £10,000 per 100 trades. £10,000 per 100 trades. And that £10,000 per 100 trades is still blooming attractive, isn't it? Okay, that's still incredibly attractive. Okay, and remember that number for a second. I said, I'll be a day trader, Bill. I'll do 100 trades every week. Why not? 50 weeks in a year. The other 2 weeks, I'll be on my private jet, on my yacht, Bill. You know, you can imagine. You're like sitting there and you're thinking, wow, my life is set. 5,000 trades per annum at £10,000 per 100 trades. That's £500,000. I know what you're thinking, and you should be. Alpesh, what drugs are you smoking? Alpesh, we're not going to do 90% of that. We're not going to do 80% of that. We're not going to do 3/4. We're not even going to do 2/3 or half of that. We're not going to do 33% or a third of that or a quarter of that or a fifth of that. We're not even going to do 15% of that. Let's assume, and rightly so, all my numbers are absolutely high octane nonsense. Let's say we did 10% of that for a second. That'd still be 50,000. Well, hang on, 50,000 is still far more than the 500 a month I said is our target. So we're still being too optimistic. And Bill said to me, dial it down, Alpesh, dial it down, keep your day job. And he was right. He said, continue studying at university, don't drop out, because he didn't want to make that call. Let's say you keep your day job and you just do 100 trades every 6 months. Okay, 100 trades every 6 months. That's one a day. I said, why? Why don't you want me to do that? He says, well, you got to walk before you can run. And what if you mess it up? You can't go in a Formula One car on day one just because you learn how to drive in a Mini. Okay, so this is what he said to me. And it's the best advice, because most people don't tell you to go slow in life. They tell you to go fast and get a move on. He said, no, just work it out, go slowly. And he was absolutely right, because it meant I didn't crash and die early in a car. 100 trades per 6 months, 200 trades per annum. That's £20,000. So it's not 10%. We're closer to 4% now. Okay. But wait a minute. That's still way more. Even 4% of our business plan is way more than the 500 per month I said we're targeting. So I like this business plan. I like it because we don't have to get 100% of it. We don't have to get everything right. We don't even have to get 10% of it. We can get about 4%, under 4% of it, and we're okay. So then I said to Bill, hang on, if that still helps us get our targets, even without being so ridiculously over-optimistic on all the numbers, as a business, this looks like a good business to have. How come everybody isn't rich? That's the obvious question to ask next. And he said there's 3 reasons for failure: bad teachers, bad mentors, bad strategies. So let's focus the final part of the webinar on the strategy, the entry strategy. The exit, I've already told you, trailing stop loss, or trailing stop loss, or if you're a beginner, hits your take profit. So let's talk about the entry. 100 trades per annum. That's my mum again. 100 trades per annum. Sorry, 100 trades per every 6 months, 200 trades per annum. Wrong. You're not listening. I said 500 per month. It's not that. It's 500 per month. Okay? 500 per month. Excuse me. It's summer. Right? So we're going to keep it simple. We're keeping it simple. We're keeping it cautious. We're being slow. Not the things you ever expect to hear on a trading webinar. The exact opposite of what you expect to hear. We're not looking ever to get rich quick. You can't. I've been doing this long enough to know you can't, unless you're lucky. But then you might as well just start filling the lottery. We're going to do it a bit by bit, because it's all I've ever been told. And if I told you any different, you could go buy the book and say, hang on, but the book says you've got to do it slowly. So why did Alpesh on the webinar said you can get rich quick? You can't. This is what we're going to do. So let's look at the strategy. And these strategies are listed in my book. Look, international bestseller, published by the FT. I'm very proud of that, as you would be. Okay. Did all of that. It's done all of that. This is what we're going to be. We're going to be that guy. We're riding a trend. Somebody else moves the market. That might be Goldman Sachs or whoever, whichever conspiracy theory you believe in. But we're going to be that guy following the trend. That's what we're doing. So how do we do it? So I said to Bill, so how do I do this? How do I know when to enter? He said, well, what you're going to do is you're going to measure momentum or the start of a trend. And I said, well, look, Bill, I don't have the money. I'm a student. I don't have the money to have some fancy piece of software or 500 analysts like you've got at Salomons. He said, no, I'll give you an easier way to do it. I'll strip out. It's like saying, look, I'm not going to give you my Ferrari, says Bill, or his Lamborghini or his Formula One car, but I'll strip it out and I'll give you a mini Maestro or whatever instead, and it'll still do the job. It'll get you from A to B. Or here's a bicycle I'll give you instead. Okay? Because at least the bike's free. All right, so this is what he did. And he said, we're going to measure how close to the high the price closes in any period, because that gives us some degree of momentum. It's a bit like those TV auctions you see. It says, I've got 50, anybody give me 100. I've got 100, anybody give me 110. I've got 110, anybody give me 120. Okay? We're going to measure how close the price is in any period to the high. So what we were doing here, whoops, I'll move this across, is looking, and this is where the fortunes are made. This is where the billionaires became the billionaires. It's not very many businesses where you can actually see X-ray where they made their money and how. Okay? All we were doing there was looking at how close, not every period, but overall was the price closing near the high. But we weren't doing it by eye, because I said, Bill, what am I supposed to do? Get a bloody magnifying glass and do it. And why does that work? He said, well, it's like this. It's not guaranteed that it will push the trend higher. But he said, we're not just going to look at is the price closing near the high, but is it also making higher highs and higher lows? So we're not just going to look at one thing. We're going to look at multiple things across multiple timeframes. And I said, yeah, but Bill, I need to simplify this. I'm a student. I'm at university. I've got more important things to do. Okay. So he said, yeah, well, we'll use indicators which are freely available, but not the way the textbooks use them. What we'll do is we'll use multiple indicators and see, are they flat to rising? So for instance, we know indicators like the MACD are free and they measure those things, higher lows, higher highs, price closing near the high, but we won't use it the way textbooks do because they're wrong and they're lagging. What we'll do is we'll see, is it flat to rising across not just this time frame, but multiple time frames? So what he taught me was what all hedge funds do. They look at multiple indicators. Now, they'll have their own proprietary ones. I couldn't afford proprietary ones, so I use public ones, but in a way that the textbooks don't. So write this down, multiple indicators in a way the textbooks don't. So he started showing me how to use the MACD, flat to rising. Do you see? Flat to starting to rise, stochastic, flat to rising. So whatever indicators you use, multiple indicators, so you're filtering bad trades out. Okay, you might filter out some good trades, but that's fine as long as you filter out bad trades across multiple time frames. You didn't just look at the time frame you're trading, you looked at the next time frame along and saw, is there a similar pattern? Because that suggested longer term momentum as well and reduced the chances of a pullback and being whipsawed out of a trade. All hedge funds do that. They look at multiple time frames, they look at multiple indicators, and the final thing they look at is PC and PR, and I'll come to that in a second, and that was critical to success. So let me put it in another chart like this one. Okay, so we get multiple indicators. This happened to be the daily, it could be hourly, could be whatever. Multiple indicators, multiple time frames, flat to rising. Okay, that's critical. And price confirmation, that's PC, price confirmation. Now, incidentally, we now use Microsoft Azure, their AI for pattern recognition, which is what PR is, over a 20-period history, but you don't need to worry about that and you don't need to concern yourself with that, and it doesn't make a difference to you. Okay, so price confirmation, did the price make a 2-period high? So multiple indicators, flat to rising, stochastic and MACD, multiple time frames, price confirmation, 2-period high, whether it's a whatever time frame you're trading. Okay, that was it. Now I can give you a lot of complicated stuff if you want and bamboozle you with complexity. I don't think it helps you. There's your city one. It's gone a little bit higher. Fine. Okay, where's the Dow one? The Dow's come off. Remember, we were short and it pulled up. It's now dropped back down, which is good news because we're short the Dow. Okay, that's what it was doing. What was it doing? Multiple indicators here were flat to falling across multiple time frames. Notice how we couldn't get in up here, and we certainly didn't go short here while the market was still rising. And that was it. One trade a day, scan, and take a picture of those instruments. They're the ones we're focused on at the moment for the next signal. Now, you're going to do one trade a day. And I showed you the maths on it because you know what that business plan was built on? One trade a day. The people who can do this, therefore, by having simplified it and stripped out the complexity, are everybody. That's the talk I gave at Bloomberg. And in that audience, there were full-time moms, students, full-time plumbers, professional traders, very few of those, school teachers, side gig entrepreneurs, retirees, but everybody. And that worked out well because I was a student when I learned this. And I was at university when I first met Bill and wrote the book, Red Carnation, Last Exam. Perfected the strategy then, copied it, practiced it, won awards, including in the FT. That's me. There we go, in the FT. All right. And the FT then said, well, would you like to write a weekly column on your trades? And I said, yes. I did that for 5 years until my and would you like to write books on it? And we'll publish it. I said, yeah. That helped raise the profile, which then helped me to raise capital. Without profile, you can't raise capital. That's a whole different conversation. When I won that competition, that I didn't look like that when I won the competition. I was younger. I look closer to that. Whoever that bloke is, that's me. And then I used the strategy with companies like Merrill Lynch because I had no capital. I didn't have money. I was just regular. I mean, I didn't have enough for a hedge fund. I needed $1 million for a hedge fund. I still didn't have $1 million out of university because I started without a silver spoon in my mouth. They, amongst others, paid me $1 million. Them, American Express, a few others, and I used that to set up the hedge fund. That's me, my very first set of offices at the fund. Very first set of offices at the fund. Then people kept saying, well, can you teach us this? And I said, no, we've got a fund now. I don't want to teach this. And years went by, and a friend of mine called Biku Alawalia, who's at Barclays, said, we'd like to IPO this. We'd like you to turn this into a software company. We'll raise you venture capital for it, float it eventually. And I said, no, because I'm busy with the fund. And as the years went by, more and more fintech companies, as opposed to hedge funds, became billion-dollar companies. And he said, look, why don't you do something which beats what everybody else is doing? Don't charge a daily, weekly, or monthly fee. Don't do what others are doing, which is they leave people alone after a weekend. No travel costs, no trading, you can do live trading. They get it for life, updates for life, data for life, but no daily, weekly, monthly subscription fees. And he took a while to, I met him last week. He was in London, and we've known each other now about a decade. And the idea, and I said, yeah, I'd like that. If Barclays are willing to help me launch this and then get me venture capital funding and eventually IPO it, this could become $1 billion company. And I loved it. And that's what we did. We put it together as a piece of software fintech to take out of a hedge fund our technology and simplify it for the private investor so that that's Bitcoin. We're on the 15-minute bars. We're long on Bitcoin at the moment on the 15-minute bars. That could exit in a minute. I don't know. I don't know when it's going to exit, but that's where we are with it. And it's been from this morning, and it's been sort of peltering around sideways. The Microsoft one is there. That's where we are with Microsoft, and it's in positive territory at the moment. So there you go. I've not seen what's happening what's happening right now with the markets, but that's where we are with those. Okay. That's what we did. We started putting it together, and we think we've got $1 billion piece of technology because it helps all those private investors around the world, everywhere in the world that they are, to improve their trading, because it avoids them making the classic mistakes of where do we put a stop loss, where do we find an entry, because it does it for you. It finds those entries, it scans all those markets 24/7, and it knows where the entries are. If you want, you can get an alert on your phone. We don't recommend it, because whenever we've done alerts with people go nuts, because obviously if you've got that many instruments and you've got 15-minute, 30-minute, 1 hour, 4 hour, you're going to get loads of alerts all day and all night, because these are 24-hour markets. These markets open 24 hours a day, 7 days a week. We far prefer people scan the markets 15 minutes a day. What we think you should always have with software, anything like this should be broker independent, shouldn't be a daily, weekly, or monthly charge. Too many companies are saying, oh, we want to hook you in, please give us a subscription fee, please use our broker. No, they've got a conflict of interest with you. As soon as they say, please use our broker and here's our monthly charge or weekly charge or our software charge, they've got a conflict of interest to keep you roped in forever. I don't like that. We've got students who have used our software and then said, oh, look, I'm moving countries, I'm going to be really busy, and they've come back a year later and it's fine, because they still get mentored. Without an indicator, this is the problem. This is what life is too much like for too many people, because they're having to do it manually. With an indicator, and this is why we created it, it's like this. You've got automation. You can see a lot more and spend a lot less time. See a lot more, spend a lot less time. Don't worry about that one. We called it, well, this was Biku's idea. We called it Project Pitt's Predator. And he was, Barclays, he moved up quite quickly at Barclays. And so when he said, look, we can help with the funding and all the rest of it. And it was really because he knew what we were doing in the fund and wanted to know himself and learn himself. So buy when the price goes above the horizontal line, because that confirms this price momentum, allows alerts. We've been going now for several years, and I want to get to about 2,000 people using it. We've got to about 1,800. And with that 2,000 people using it, they've got it for life. There's no daily, weekly, monthly. Once we've got the 2,000, we've got a big enough sample size to say to venture capitalists, we want, I don't know, 20 million, 30 million for their stake in the company, and we'll work out what we value it at. And then 3-4 years later, IPO it, because we think it's a piece of software. And you see it in finance so often, which is global, and it revolutionizes it. By the way, very important piece of information, H1, 1 hour time frame we found was the most lucrative. You can see it there, and I've marked it there. We're typically getting about 25 trades a month now. Some months you might get as high as 40. Some months it's just got more signals. Some months we're fairly quiet, and you might get as low as 16. Net pips captured, winning minus losing, 2,250. Win-loss, best winning streak, a bit like a coin, 70 wins out of 100. Worse, 30 wins out of 100. That doesn't matter, as you're going to learn in a second. What matters is, by the time a stop loss was hit, 50 pips. If you're doing $2 a point, don't do $2 a point. Don't even do $1 a point. Anybody who wants you to do $1 or £1 a point, I guarantee you they're charging you a daily fee, and they've got a brokerage they want you to trade through because they know you're going to blow up quick and they can take your money. Okay, don't even do that. There's brokers which like to do 7 pence or 7 cents a point. Start off with those, or even better, a demo account. So let's say you did do 2. Eventually you built up to 2 because you're consistently profitable by then. Well, 2 times 200, 2,250 means you'd be making profits of 4,500 a month. Hang on, I said 500 a month is what we're targeting. So we knew then, actually, you don't need to do $2 to hit our monthly target of 500 a month. You can just do 20 cents. That's when we knew we had the Google of trading, because like Google, this scans the internet for information. Well, this scans all these instruments for information like Disney or whatever else. And that information being, is the price moving upwards? Is there a trend in place? We'll be adding to that winner soon. As soon as it crosses that point, which is 51.89, okay, where's the ad? There you go, 51.89. It's told us what that point is. The software just does it for us. You do it manually. We used to have to do all this manually. Before I had a team and a staff and a fund, I'd have to do it all manually. Okay, 500. So we knew we had the Google of trading because you could do it with 20 cents. So if that trade lost, you'd be losing 20 cents times 50, which is $10. That's not bad. $10, fantastic. And some months you made more than 500, some months you made less. And the idea was it would iron out. So you averaged your goal. Now, once you're consistently profitable, you can increase capital, but that's the only time you'd rationally increase it. Because if you can make 500, you can make 1,000. If you can make 1,000, you can make 2,000. But the point is, you don't do that until you're consistently profitable to begin with. You don't just say, oh, let me just go on the motorway and risk it all. So then with Bickery at Barclays, we finesse this somewhat. We'll give people a business plan. We'll look over their shoulder. As a mentor, I'll look over their shoulder. They'll send me the screenshots of the trades they're looking at. And we'll be able to say to them, no, that's a good trade. No, that's bad because look, the volatility of the position. Why would you do that? And so on. They can sit an exam if they wish. They can put it on their LinkedIn. So some people get it for their kids. They can put it on there. We track their performance. There's a 12-week bite-sized training course. It's for life because it's updated. You can spend 12 weeks on it. You can spend 100 weeks, or you can spend 2 weeks on it. There's a 30-day one as well, which goes with it, which is updated. We benchmark them, and it's theirs for life. No daily, weekly, or monthly charges. We wanted to do something different to anybody else. As a hedge fund getting into the fintech business, we needed something to have a massive payoff, and the massive payoff was the billion-dollar valuation, which a piece of software like this, I think, can ultimately have. But the only way to do that is to make it an absolute no-brainer. So we said to people, such as yourselves, use it for 30 days. We'll give you signed copies of my 2 most recent trading books to keep just for trialing this. It's yours for life if you want to keep it after that, but risk-free for 30 days. 30-day course, 12-week course, strategies for Forex, stocks, indices. It works on all of those because the algo can work out what the thing is as well. No ongoing costs, lifetime mentoring. We really wanted it to make a no-brainer because our costs for giving lifetime training and all the software updates, we're on version 4 at the moment, our costs will come back in the future when we got venture capital investment and so on. So at the moment, we don't mind running this at a loss to ourselves as a piece of software, as a loss to ourselves to get more and more people in front of it. We also realize we've got no competition. There's absolutely no competition to us out there. There's no other hedge fund which has gone to the retail market, because that's where I started out as a private investor, and said, here's something you can use, because they've never worked out a way to make it worth their while. It's only worth our while if we can IPO it eventually. Now, hopefully it will do that. Otherwise, I'll have just wasted loads of hours of my life. Professionally trained communicator, as well as a barrister. I was trained by Bloomberg TV, where I did my own TV show there as well. I'm paid by them and the Financial Times for my weekly column. So we had the credentials. I'm a visiting fellow at Oxford University. The credentials to keep on going and put all that into the FT Awards. Once we realized we had no competition, it became obvious to do this. I'll give you the link. I'll give you the link. Sorry, some of you are asking for what's the link. We take on a small number of apprentices. So the question is, can it make money? Well, I'll show you some more trades. Is it easy? Yeah, because you're following signals. Can I do any time of the day job? Yes, 15 minutes a day before and after work. You're scanning the markets. How much does it make? Well, we showed you the business plan. This is my students. Full disclosure, these are my students, not my trades. And some of them don't listen to what I say, and they do different time frames. They do 5 minute. I don't like 5 minute because I think it's too short. But anyway, 5 minute bars. Why were they doing $30? Because they were experienced. They'd built up a war chest of capital and profits that they could do that then. They do that eventually. So $2,250 in 3 hours. But that's because they'd spent a year or two building up that capital. You don't start like that on day one. Obviously, if you started sooner with less, you might have $200 profit instead in 9 hours or whatever. But that's the point, that we want to be cautious, cautious, cautious. So who's behind it? Well, one of the people who endorsed the strategy is chairman of the Chicago Board of Trade, and it's in print, it's in the book, gets to the heart of the matter of trading by clearly elucidating the methodologies of successful trading strategies. This is not Mrs. Smith from Croydon or Mr. Jones from Manchester. These are people with proper credentials, That's what we're trying to do. With an indicator, it's easier. 30-day, no quibble, 100% money back guarantee. Okay, we want to build up the numbers. We want to get it to 2,000 people through it. And we take them in batches of 25 at a time. That's because that's the Barclays guy. He's now left Barclays and lives in Dubai. Loves the bits where I now spend most of my time trading and love that as a novice. I know, well, he's not a novice anymore because since he's given that quote, he's become very experienced. I know what to trade when, how much, can leave the exit price and get on with my other work. Okay, and he just flew back yesterday. Actually, he was in London for a while. And I stole something from my alma mater. The mentoring happens through videos, Zoom, website. I've started doing live things now because post-COVID. So actually meeting people, inviting them to events as well. And it's bespoke to each individual. So we had one individual who said, oh, I can't get the timeframes right. So we said, right, let's do it bespoke to you, one-to-one. My most successful student ever is, I'm going to show you who that is that one. She left university, started my assistant for 2 years, and now runs 10 billion. I can teach anybody to be a fund manager. Okay, I can teach anyone to be a fund manager because it's not that difficult. It is not that difficult. Okay, the timeframes I prefer are 15-minute, 30-minute, and 1 hour. I showed you the 1 hour is the most lucrative, but I prefer looking at all of those. And you can see which ones we're looking at right now. There you go. Take a photo of that. You can see it. Look, you can see it there. What time frames? 1 hour, 1 hour, 1 hour, 4 hour, 30-minute, 30-minute, 15-minute, 30-minute, 30-minute. And you might say, well, how do you decide which time frame? Well, you look at the smoothness of the trends, and that's what you want it to operate on. You want to see which roads are smoother. We take 25 people at a time. They're in it for life, but because I'm mentoring them personally, that way I take them in 25 groups of 25. And then when I've got enough time, I take another 25. When I got enough time, another 20. They're in it for life. They get updates every single day. They get all of this, all of that. So if you'd like to sign up, that's where you go. Oops, I'll put the link up. That's where you go to sign up. And you'll be part of my alumni network, as it were. You'll be coming to live events with me as well. I've occasionally even invited people to the BBC when I'm doing that and met them at the sort of foyer before I've gone in and stuff. And so you'll see me there, or I've done events in other parts of the world and sorry, I put it on the wrong screen there. And they'll see me there when I go in to the Beeb or CNBC or whatever. If I've got time, I'll invite them, and I've done that in the past. So one thing that we found is by having that alumni group and helping each other, it's been phenomenal. If you look at Alpesh Patel reviews, you will see interviews with some of our students. And those, sorry, typed it in wrong. Alpesh Patel reviews. I'm going to show you some more of the trades we're looking at the moment as well. Well, I've shown you all of them. Please take a picture of those and have a look at them yourselves. But if you look at Alpesh Patel reviews, you will see a whole bunch of students and live interviews with them as well. Load, and we've got more coming up as well. And we've got written case studies as well, so you can read them relating to the interview. So if you click on there, you'll see the videos from the various students. Okay, so if you were to click on there, you would see the interviews. Okay, and that's when we knew, okay, we're on the right track. This is really simple. Keep it simple, like everything else in my life. Keep it simple. Don't complicate things, and just take it from there. Copper. Somebody asked about copper. There. That's our copper position. That's where it is. That's where the stop is. That's the trading stop loss. It's moved up to here now because the price has moved up here, and we've added to that winning position here. And if you said to me, "Oh, Alpesh, but what about China? What about economics? What about that?" I said, "Well, I don't know. We're trend following. We don't need to know global economics, macroeconomics." Also, don't get me wrong. I got a master's degree in economics from the #1 university in the world, but I don't need it for this. And the funny thing is that the interview for my admission to that university, they said they knew I was into trading because I told them and I discussed it in my cover letter. And they said, "You know, what we're going to teach you is not going to help you as a trader." And I said, "Yeah, I know. I've worked that out already." And that was phenomenal. Okay, so download. You can start downloading it instantly and start straight away. Yes, you can start. So, we've got quite a few coming in. Okay, thank you. I've got a David. I've got Jitesh who's come in. I've got Mittal who's come in. Got let me see, who else have we got over here? No, it's gone through. Jonathan, it's gone through. Kevin, it is through. Thank you. I'm excited as well. You can download it straight away. So when you go to that website, what you will see is and I try and meet all my apprentices as well. So if you're in London in particular, it's easier, but I'm going to be in the States soon. I'm going to be in India soon, and all of this. So I do try and meet you all. So if you go here, sorry for the absolutely awfully looking website, alpeshtrell.com/. If you go there, the reason for it is very simple. I was told if you have a big yellow button, people know where to go. If you write hurry, people get on with it. Okay. On webinars, we reduce it to 1995. The reason for that is when I do a webinar, I know I've got the time to take on 25 apprentices. Outside of that, my time's at a premium and therefore the price is higher. We also have a team of people, and we've got a phenomenal dedicated website as well to all of this. And you'll be able to see our team. We've got team for just, installing it. If it takes you more than 10 minutes to install, we'll do it for you. Okay. So our team can help with all of that. And when you go onto the website, you'll see that we've got a whole bunch of resources there as well. Okay. And the guys will, like I said, install it. Won't take too long. If you click on here, if you click on there, you can even do split payments and you still get instant download. Okay. 30-day money back guarantee. There is no, got a few more. Seb, Neil, Nigel. Yes. Gone through. Thank you very much. Any issues, let me know. Thank you. Thanks very much indeed, Ravi. I'm going to post that. Thank you. We've got two Sebastians. No worries. Here we go. Well, how do I post that? There we go. Thank you, Ravi. Indeed. Look, you know what the big plan for me is. It's a piece of software. I always wanted to be in the software business because I kept seeing software companies like Microsoft making silly money. But we thought we can't charge private investors because you need to be business to business. So how can you be business to business to make the bigger sums? You get the venture capitalists in, you prove the product, and that's how you do it. And that's it. Why do I do the webinars? For a very simple reason. I'm the one mentoring. It's my baby. This spin out from the hedge fund is owned 100% by me. When Steve Jobs used to launch this, he's the one who walks out on stage and says, "This is my launch." It's when I was doing Bloomberg Television, on every single screen, Bloomberg terminal screen, it would have Michael Bloomberg's name and signature and say, "You got any issues, you talk to me." That's why when you take that level of ownership, it doesn't half make sure that you as an individual make sure you keep improving and make something absolutely outstanding. Oh, by the way, every Saturday, we also have webinars, 11 a.m. on stop losses, 12 o'clock on entry, 1 o'clock on limit orders, 2 o'clock on money management, 3 o'clock on trading psychology, 4 o'clock on adding to winners. On top of that, you got Skype, Zoom now. I put Skype there. It's more Zoom everybody uses. Email access, meet me, part of my trading club, lifetime mentoring, customized trading videos, any questions you got, signed copies to keep, plus a little goodie box just for trialing this for 30 days. And you can keep the box afterwards. Thank you, Sebastian. I'm delighted that you enjoyed it. Thank you so much. Babs, it's gone through as well. I can see that as well. Catherine, yours has, and Marcus, thank you very much. And I'm excited as well. Whenever people are excited, I'm excited. And the great thing about taking on new apprentices every time is you've got a whole new bunch of people who are going to sort of the light bulb moments they're all going to have where they say, "Oh my God, I never knew it was like this. I get it now," and that's exciting for me. And it's fulfilling for me. So there's an added bonus. Oh, Amazon. Yes, I can show you Amazon, Jared. I can show you Amazon. I can show you, he says. Have I got it? There. That's your, so that's Amazon. 30-minute bars. That was 30th of June. Blimey heck, that was ages ago. And that one, then it went sideways a bit, but we had a good run up in that one for Amazon. Oh, I've got another. I've got the 1 hour Amazon as well. The 1 hour Amazon's a short. That's the 19th of August. And 24th, right up to now, is just slightly going into long. Okay, so that's where we are with that one. Okie doke. And that's Amazon. Let me see. Dow. Oh no, Shell, petrol. What do I think will happen with petrol prices? I don't know what's going to happen with oil prices. I suspect they at some point will move lower. I would have thought so, given what's been happening most recently. But yeah, I don't want to guess or gamble on it, on what I think might happen with that. Any questions you've got, let me know. Let me know at all. Otherwise, I'm going to call it a day. Thank you, everybody who signed up. I think we've got a couple of places left. So if you haven't, let me know. 6 simple steps. You go there. You can download it from there. 10 minutes to install, or we'll do it for you. Follow the signals. Trade through any broker you're happy with. You can use any broker you want. Susan, you can use, it says it there as well, any broker you want. And there's a mentoring site, videos, all the rest of it. My 2 ambitions to be in one of these 2 lists. Simple as that. Okay, so you know where I'm coming from, and I want to make sure I'm transparent about that. In case you're thinking, yeah, why are you doing this? What's the motivation then? That's the motivation. It's to be on one of those 2 lists. Simple as that. Absolutely simple as that. And we'll see which list I end up on. Sorry. The best currency pairs: minor versus minor, or minor versus major. I'll give you an example. Let's take. I'll give you an example. Let us take Australian dollar, Japanese yen. Okay. That one didn't work out. That one has worked out rather nicely. Australian dollar, minor currency, Japanese yen, major currency. We found those trends tend to be easier. Can you see how this is just smoother? Look at that. So no wonder we're waiting for the next signal on this as well, because it's just smooth. I know that trend didn't work out, that trade, but it's smooth. It's just moving smoothly, nicely. Okay. Human eye can detect that. And major versus major currencies like sterling, US dollar tend to be a lot harder. And for novices, I'd say avoid it. But we teach you all of this anyway. We give you a little manual where you see all of this. So we make everything that much easier for you in any event. And you'll be my apprentice. I copied these 2 billionaires. You'll be my apprentice. They have apprentices. Why should I not have apprentices as well? You'll be my apprentice. Okay, what brokers do I recommend? David said only 1 ticker. Your thoughts on just trading, say, S&P? No, David, the reason of not trading just 1 ticker is you're just restricting yourself to, you're going to have to spend more time waiting for a trend. So your return on time is going to be lower. It's just obvious. It's just logic. Whereas if you're looking at 2 different things, you've doubled the opportunity to find trends, just mathematically. That's the problem. And most people say, no, I'll be an expert on this. I say, well, look, if you can make it work, but please work out your return on time. Return on time. Please work that out. That's my worry about 1 ticket. Any other questions, just let me know. Okay. Manissa, it's gone through as well. I've got a cousin called Manissa. I don't think it was you. That's gone through. Thank you. Kid, I'll send you a link in due course on that. No worries. Any other questions? Let me know. Otherwise, I'm going to call it a day. I've kept you for 90 minutes. I wanted to try and keep it less than that. I do try to keep it less than that. I want to thank everybody who's been on here. Any questions at all on this, then just let me know. Yes, I can do that. Somebody's asked me, what about some of the tickers you've not gone through? Boom, 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 boom. Pick one. JP Morgan. Where is it? JP Morgan. JP Morgan. That's a buy over there. There was a sell. Now, this is the thing about trading. The trading mentality, you need to remove the human out of it. And this is a classic example why. Because otherwise, the human's got to be on the 18th of August saying, oh, I'm short JP Morgan. I think it's rubbish. And then on the 25th of August, be saying, yes, I like JP Morgan. I'm long JP Morgan. You can't do that. You can't. A human finds that difficult. A computer doesn't. It doesn't have emotions. That's why we prefer the computer. Do you see how detached we are? They say psychopaths make better traders because they don't have emotional attachment. I think people using computer systems like this make better traders. Okay, that's why. It means I can do other things while I was watching over my shoulder, the one ticket. No, that's fine. That's fine. If you can get a better return on time, that's fine. Thank you, Nigel. Welcome on board. I will check. Yours has also, I can see, I think it's gone through. I can see the others as well. So that should be fine on that. Now, where are we? Oh, thank you, Carwin. Sorry, I hope I wasn't low energy at any point. Sometimes with the heat and everything else, it can be a little bit. What more can I tell you? Oh, the Telegram channel. Let me tell you about the Telegram channel. So we have two Telegram channels. We have a public one, which is there. Okay, that's my public one. Sorry, excuse all the blooming emojis. That's the public one. Okay. And then we have a private one just for, where's it gone? Just for the students. And the private one will show you which trades we're looking at each day and so on. So it'll tell you we're looking for the next signal on, for instance, euro, Australian dollar. And my team, it won't necessarily be me looking at those trades because I've got a team to do it. They'll be looking at, or they will have said to me, these are the ones you should look for, boss. They don't call me boss, but I wish they did. Canadian dollar, Japanese yen, they'll say, look, we like this. That's the next one. Or they've been doing it, and then I'll independently look at it as well. Australian dollar, Japanese yen. Look, you can see the smoothness of the trend, and that's what we're really looking for. We're looking for those kind of patterns. That's where we want to superimpose the algorithm. That's where we want to superimpose Pips Predator. Take it on a road for a spin like this. When it's going like this, like somebody's heartbeat, oh my God, I do not want to be putting it on those. Okay, and that's probably the most important thing we have to teach people, is just recognizing actually these are things. And then we make it even easier because we show them on the Telegram channel what we're looking at and what seems to be doing better and moving more. So that really helps as well. Okay, everyone, I want to thank you all for being on here. I think we're out of spaces in any event, but for all those who signed up, welcome on board. You will get a personal email from me with the login and password and direct communication with me, including setting up our calls with myself and with my team, who will install it for you if need be. And so you'll get that personalized email. Just give me a second to catch up on a couple of calls straight after this. You'll get it in the next 30 minutes or so. And that personal email will have my video intro, because I like to introduce everybody personally so they know it is me doing the mentoring, which I know we've got a unique selling proposition. They've got a hedge fund manager doing the mentoring for them. And, you know, we want to use every advantage we can get. You don't think Apple do? So thank you all very, very much for being on the call, on the webinar. Really appreciate it. And as I said, thank you. Any other questions, just keep going and let me know. Thank you very much.